welcome to the 2015 Performance Summary for Process Portfolios. I'm Dak Hartsock. I'm the Chief Market Strategist and Director of Investment for ACI Wealth Advisors and Process Portfolios. For those of you that don't know me, you may visit dakhartsock.com/about if you'd like to learn a little bit more. I'm a nationally cited financial and investment expert and an award-winning portfolio manager. Let's go ahead and move on into the presentation. And out of respect for your time, because I've got some clients and some subscribers that are pretty busy people, I've front-loaded this presentation. So the crucial points are in the first 4 or 5 slides, and I'm going to try to get through that in the first 4 or 5 minutes. So in the interest of time, let's just get right into it. I'm going to hit a couple of highlights along the way. Live portfolios outperform benchmarks in 4 of 6 portfolios, and 3 of them actually outperform the S&P. Only one of those is truly designed to do that. So that's not a bad outcome for the year. We had very significant outperformance in market income. More about that a little bit later, but that portfolio is really working out well. Made some adjustments to durable opportunities at the halfway point of the year, and from that point forward, durable opportunities has outperformed its benchmark on a fairly significant margin, and anticipating that's going to grow barring a recession into 2016 and beyond. Got some adjustments in process for a couple of the portfolios to position them maybe a little bit better for 2016, 2017. And the recession probability indicator, or RPI, is still showing that we have a stable economic environment. It's not stellar, but stable. And of course, as history has shown, that's a reasonable place to stay invested. So let's go ahead and move on. Some concerns I want to talk about very briefly for 2016. There is a rising possibility of recession. Don't see it yet, but we keep our eyes on it, something we're watching for. The Fed is raising rates, as most of you know, and they're guiding for higher rates in the near future, and what that's doing is allowing volatility to return to the markets. So we're anticipating that that's going to cause volatility average levels to rise 20-25%, somewhere in there, versus what we've seen since QE was started by the Fed. Now, what does that mean in English? It means the market's going to move both up and down, and when it does, the moves are going to be faster and larger. So it's going to move up and down more often, it's going to happen faster when it happens, and the moves are going to be bigger. So, the first week of 2016, we saw a 6% down move in the S&P in 5 days. That's pretty substantial. Yesterday or the day before, the S&P dropped 2.5%. Again, this is kind of indicative of a market that's becoming more volatile. Without a recession, it's not something we need to be excited about or stay up at night about. So there is the possibility of contamination from the oil and gas junk bond market. It's not clear exactly what that impact is going to be at this point, and it's also possible that the benefits that come with low oil prices may outweigh or at least make market neutral whatever impact we get from defaults in the high yield credit market on behalf of oil and gas explorers. So we'll see how that plays out, something we're watching. Believe the gains for 2016 are liable to come in the second half of the year. That's because earnings are most likely going to strengthen a bit. We've had earnings weakening for several quarters, and now they should begin to strengthen again moving into 2016, so that will support any second half gains. In the meantime, we do believe that there's going to be a big chunk of the gains from 2016 are going to come from things like, dividends, income producing activities with portfolios. So things like, our market income portfolio should do reasonably well, barring recession. Equity builder is something that can also create some additional income as well as protecting some of the potential downside in portfolios. So we're going to be using equity builder maybe a little more aggressively. More on that farther on in the presentation. The presidential election, of course, is this year. Not really sure how that's going to impact markets at this point. When we have a better idea, obviously we'll communicate that, but just know that we're doing some thinking about that as well. Quick review of how various asset classes did in 2015. You can see there's a lot of red there, and it wasn't great performance. A couple of highlights. The S&P only did 1.3%, but in keeping with the theme that those of you that regularly watch these presentations or read the articles don't like anything outside of the U.S. really, and here's why. This is the world outside the U.S. It didn't even keep up with the S&P. there's just a lot of risks in things like emerging markets, developing markets. Europe has some issues now with their immigrant crisis that are going to really take away from Europe being able to grow in our view. So we're kind of breaking from a lot of the bigger managers, the Merrill Lynches of the world, the BlackRocks of the world, in that we have stayed away from emerging markets for the last couple of years for the most part, and they've been pushing emerging markets and developing markets. And we're seeing, at least so far, that our approach maybe is a little more risk efficient. So let's go ahead and move on. Here's the live portfolio results. I'm going to go into these individually in more detail over the next few minutes, but just a couple highlights. Core equity did beat both the benchmark of the S&P and greatly outperformed a mixed stock bond portfolio with less risk than the S&P. It still lagged our model, and there's different reasons for that. Some clients came closer to the model's performance, some were lower than the overall consolidated average. That had to do with various factors such as when money went in from the client account into the portfolio, how much they contributed, what percent they put in, that sort of thing. Market income outperformed both its benchmark and the S&P, as did core equity. It actually outperformed the model, so we're pretty happy about that, and it did so with less risk. More on that later. The full cycle portfolio, for those of you that don't recall, it's basically a risk parity model built after probably the most successful hedge fund manager, certainly the largest hedge fund managers, all-weather portfolio, which is used by pensions and university endowments and things like that. And it's because it's comprised basically exclusively of assets that don't correlate. So in this case, we outperformed the benchmark. We lagged the model a little bit, and we're probably going to make a couple of tweaks at midpoint 2016, see if we can get a little bit closer to the model. Durable opportunities, I spoke briefly about that earlier. Not stellar. This is essentially due to one position, two positions, one Exxon. It really tanked along with oil. We expected oil to come down, not like it did, so we had to reduce some Exxon, and that's why we're seeing this number. Also, the gains that we figured we would have seen from Precision Castparts, as you may recall, were taken away by Warren Buffett. Precision Castparts was our largest portfolio, and all the gains that we expected to get were taken away as soon as Buffett announced that he was buying it out. So market momentum, we saw good performance here. It appears that it actually lagged the benchmark. In reality, it didn't, because we began tracking market momentum as a separate portfolio about August. And from the point of August forward, it significantly outperformed the benchmark as well as the market. Fixed income, you recall, we've got some issues with that, and the tweaks are beginning to go into place. So let's move on. Here's core equity. That's the dark blue line here. And as you can see, it's not going down as far as the S&P when things go down, and it's kind of keeping up with the S&P on the way up. We took on a little more risk moving into the end of the year. The idea is that at some point within the next several months, we're going to have a more stable market, and at that point, core equity should begin to lead. Had some problems with biotech so far this year. We're aware of it and watching it, but regardless, 2015, we've got good outperformance versus the S&P. With substantially less risk, about 26% higher risk if you buy the S&P versus core equity. And we are lagging the model. Again, some clients got a lot closer to the model, some didn't. And if you're interested in more detail on that, you can give the office a call or send me an email, and I'm happy to explain. Market income really did a stellar job in 2015. Again, here's comparisons with various places you could put your money. An index fund is the green line for the S&P 500, and the light blue line is a mixed stock and bond fund. And as you can see, when the markets went down, it didn't really go down as much. When the markets rise, it doesn't really rise as much, but its progression is steadily upwards for the year, and that's what you want to see. So great risk-adjusted performance there. Very happy about market income. Full cycle portfolio basically outperformed benchmarks for the duration of 2015. It's doing what it's built to do, which is really not lose money during periods of intense volatility, or when you've got major recessions, things like that. Unfortunately, when markets are flat, it has a tendency to underperform. When markets drop, it overperforms. When markets are moderately strong, it does about what it's supposed to do, which is 6, 7, 8%, somewhere in there. But we did beat the model and the benchmark. So that's a pretty good outcome, even though it's negative, and that can change at any time, based on market conditions. Durable opportunities is the dark blue line. Again, we did not have a great year in this, but second half adjustments, you can see they begin to take place here, and now the trend is more positive, and we're moving back towards the direction where this portfolio is designed to be rather than down. Again, that first half is almost all on Exxon and the loss of Precision Castparts to Warren Buffett when he took our largest position. So didn't get any payout for buying Precision Castparts. Market momentum. A little bit different performance here. Again, it beat the benchmark over the same period. We began tracking it in August, and what we're seeing is outperformance from the get-go and market momentum. This is what it's built to do, and on a risk-adjusted basis, it's also up there with market income and core equity. I'm anticipating we're going to continue to see some outperformance out of this portfolio for quite some time. Fixed income is the dog of the pack. They're just not getting it, or it's just not getting it done. We've got to make some additional adjustments here. Significant lag versus the benchmarks. It's not where we want to be. The saving grace of this is part of the lag is because we're in 50% cash, and some accounts it's actually a little bit higher than that, and that's because the fixed income space just really isn't desirable right now. We've got some fixed income stuff that's more targeted towards higher income versus just the bond market, and unfortunately that's given us a little more volatility, a little more downside because it's somewhat tied to equities in terms of preferreds and things like that. But again, adjustments are being made and going into place for first quarter, second quarter this year, and we're going to see at least market performance, I believe, moving into the second half of 2016 and beyond. So that's pretty much it. What we've got is a summary for those of you that want to read a little bit more about each of these strategies. I'm going to kind of pop through them, leave it up for 5 seconds at a time. You can hit pause on your video player if you want to read more about it. So here's core equity. Here's market income. Of course, you can also call the office or send me an email or hit the contact form on the site if you would like some additional detail or clarity on what these different portfolios are built to do, why they're designed the way they are. Here's full cycle. For those of you that are interested in full cycle, if you would rather deal with Ray Dalio and Bridgewater Associates, who designed this, and it's a tremendously successful strategy historically. I understand that it may have been opened up again, and as long as you've got about 150 million, then Ray might have a conversation with you about putting some money into the portfolio. But anything less than that, the lowest allocation he's taken, to my knowledge, was $100 million, and that was about 10 years ago. So for those of you that don't have 100 million lying around to invest with Ray, this portfolio as a non-correlated portfolio is probably the next best thing. Durable opportunities, here you go. I very much like this portfolio long term. Had some difficulty the last year and a half or so, but the positions that we have bought other than Exxon are doing about what they're supposed to do, and we've got a lot more that we're trying to buy. This portfolio is heavy on cash at the moment because we're not able to get the value that we're really looking for. Ideally at some point in 2015 we're going to have a huge sell-off, bigger than what we've got now, short term, and we'll be able to pick up some of these positions before the market returns to where it needs to be, or where it ought to be. Here's market momentum. This is a portfolio that I really believe is going to do well over time. It's something that I've used in my own account in the past many times with very good results. And so now we're rolling it out to clients this year as a separate portfolio. It has been used in client accounts in the past, but this allows us to track it and keep a better eye on it, and this is what it's all about. Fixed income, not too much to it. It's not really the space that ACI, Process Portfolios, or myself really prefer to spend a lot of time in. The fixed income space at probably for the next 5 or 10 years is not great. It's not going to be a great place to put capital, and there's some other alternatives we're looking at for clients that really do need some kind of fixed income solution. So thank you very much for the time. Stick around for the disclosures. The SEC and state regulators want us to make sure that these are available. I'm going to play the theme music throughout the disclosures, so if you want to fast forward and flip through, have a look at each of them, here they are, available for you. Here's the regular disclosures. This is a new set of disclosures that were required, so I'm going to sign off now. Please call the office or send an email if you have any questions. Sorry this presentation took so long, but it is a year-end summary, and we do have all these disclosures to go through. So thanks very much, and Happy New Year. Welcome to 2016, and hopefully it's going to be a great year for everyone. Thanks.